Will the Tata AIA Life Insurance Diamond Savings Plan help you fulfill your medium and long term financial goals such as your child's education or your retirement planning? Let us find out through an in depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. This is a non-linked participating individual life insurance savings plan. Some of the key features of the policy are: there is a life cover provided for the entire policy term, there is flexibility in choosing your premium payment term and policy term, and after the premium payment term ends, you will be receiving guaranteed income, and you can even get a vested compound reversionary bonus and terminal bonus if any on maturity or death, and life cover could be enhanced with optional riders, and this policy is eligible for tax benefits under section 80C. And there are other benefits like death benefit, survival benefit, and maturity benefit, which is dependent on several factors and it will differ based on that. And if you want to know about the advantages, let us take a look at the advantages now. So a large scale discount will be applicable on premiums for policyholders opting for a larger premium, and flexibility is available in choosing your premium paying mode like annually, half yearly, quarterly, and monthly modes. And there is flexibility of additional coverage by adding riders to the base policy, and policy loan is available subjected to a maximum of 80% of the surrender value, and premiums paid under this plan are eligible for tax benefits under section 80C of the Income Tax Act 1961. So these are some of the advantages. However, the disadvantages are any change in the basic sum assured is not allowed post inception of the policy, and tax benefit on maturity benefit like section 1010D does not apply to policies having a premium amount exceeding 5 lakhs payable for any one of the previous years during the policy term, which is if this policy is issued after 1st April 2023. So these are some of the drawbacks of this policy that you need to keep in your mind before deciding to invest in this policy. Now, if you want to know more about these aspects of the policy in detail, you can refer to the policy brochure. So now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to analyze the IRR of this policy, so the internal rate of return based on the policy brochure's benefit illustration. So here let us assume that a 35-year-old male has opted for this policy and has purchased this policy for a policy term of 25 years with a premium payment term of 12 years, and he has opted to pay an annual premium of 1 lakh rupees with the sum assured on death 11 lakh. So the assured benefit would be 3,52,225 rupees. So if you pay a premium of 1 lakh in the first 12 years, then in the next 13 years, you will be receiving an income benefit of 70,269 rupees. Along with the final payment, you will be receiving a bonus, which is a compound reversionary bonus and terminal bonus if it was declared. So the bonus percentage will also vary year after year. So in the tabular column presented on the screen, we have made assumptions of the rate of return based on future, just for an example purpose, of 4 and 8% to indicate worst and best case scenarios. These rates are not guaranteed. This is just for calculation purpose. So here, as you can see, the best case scenario return is 6.45% and the worst case scenario IRR is 2.55%. So here the IRR ranges between 2 to 6%. So the internal rate of return is not an inflation beating one, and the life cover provided in this policy is also not sufficient. So the best case scenario IRR seems to be better, but still it is not advisable to lock the funds at this rate for the long term, such as a policy term of 25 years. It is important to note that each year the bonus rate also varies. So as this policy is not giving us a desirable outcome that we need, let us now move on to the comparative analysis, where we are going to invest in insurance and investments separately just to see whether it can perform better if it was invested separately compared to investing in a bundled product like Tata AIA policy, which combines insurance and investment. So here, just for example purpose, let us assume that a 35-year-old male has bought pure term life insurance policy for life cover purpose for a sum assured of 11 lakhs for 25 years cover. So the annual premium to be payable for next 10 years is 12,700 rupees. So compared to Tata AIA policy, here they just have to pay 12,700, whereas in the Tata AIA policy they had to pay 1 lakh. So the balance amount would be 87,300 rupees, which can be invested based on a risk appetite. So here we are going to assume the amount is invested going to be in ELSS fund just for a fair comparison, as this fund also is a market link product. So here first, in the previous example, there is an annual income benefit of 70,269 rupees. So similarly, at the end of the accumulation phase, that is the first 12 years, the corpus, which is the post-tax ELSS maturity value, will be 22.53 lakhs, which will be invested in a 7% return instrument, and the same amount 70,269 rupees will be withdrawn each year. So here the IRR, which is calculated on the post-tax return, will be for pure term plus ELSS option works out to be 7.95%. So these rates are comparatively better than the Tata AIA policy. Under the ELSS option, the IRR provides an inflation beating return in the long run, and ELSS also offers liquidity, which is missing in the Tata AIA policy, where you get the bonus only at the end of 25 years. So it is always better to invest separately for your life's financial goals. So what is the final verdict? Is investing in the Tata AIA life insurance diamond savings plan worth it or not? So this policy offers a few key benefits to the policyholder, such as life cover, savings, regular income after the premium payment term. But an investor can get these benefits through numerous investment vehicles that are already available in the market. No specific feature makes this policy unique. It is simply a traditional life insurance product. Moreover, the IRR is also not convincing enough to invest in this product, which will lock your hard-earned money for 25 years without producing a good return at the end. So pure term insurance does not have an investment component to it like this policy, but you can get higher coverage at a low premium. So choose your investments depending on your life's financial goals, risk appetite, and time horizon.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.